Hey everyone, welcome back to another earnings, a live stream. Earnings will begin coming out within about the next 8 minutes here. So if you're catching up late, then well, you know what, we can you can fast forward a little bit. But we've got a lot to talk about today regarding earnings. Big earnings from Facebook. Obviously, we want to see what's actually going on with advertising. Google was not a good heads up. First of all, Google extremely slow at actually reacting to the disaster that's going on in the environment that is in the macroeconomic cycle. Google should have known since January that now's not the time. It's just not the time to be hiring 13,000 people. I do worry that there's a chance we're going to have to see some sort of layoffs at Google at some point, but we'll see. That was yesterday, right? So the question today is, how's Facebook going to fare? And look, here's just my honest take on Facebook. I've never been a Facebook investor, so I'm biased in that sense. I've never been a big fan of Facebook, the platform. I liked MySpace better. Yeah, but but then again, I'm a little jaded. I feel like I was never really into social media, uh, which I know is a little ironic today, obviously. But yeah, I was never a big fan of social media, so I have that initial bias about Facebook. But I will say the thing that has me most concerned about Facebook, because when we look at their valuation, it's like, oh, well, that doesn't actually seem like it's that terrible, right? The problem is growth. And the growth is, in my opinion, probably ending for advertising. And they would be lucky if they could just continue, in my opinion, to milk this cash cow that they have of ads that they have. And the problem is you've got Mark Zuckerberg doing essentially what my take is this sort of a Hail Mary to turn Facebook into the new frontier for digital advertising in the metaverse. And unfortunately, I think he's just 20 years early. Now, I hate to say that, but it's true. I mean, I just think he's way too early for this virtual reality transition. That's Facebook. So I'm not optimistic at all, especially with YouTube revenues being down year over year from Google earnings yesterday. Not very excited. TDOC, the last time we covered TDOC earnings, they took like a big old goodwill write down, and still they have like a $6 billion goodwill account. I mean, there's some weird things going on their balance sheet. Especially with their goodwill accounting. If you're an investor in TDOC, you should absolutely be demanding insight into what's going on there. Spirit Airlines will be interesting because the airlines are still killing it. And American Airlines, in their earnings call, we were covering this in the course member live stream, they are indicating demand is continuing with no sign of demand relaxing. This is actually very similar to what you saw with Enphase. Enphase also talking about no indications yet about demand relaxing, although they did have one minor red flag, but in response to an analyst question, but then they wanted to take the answer to that offline because A, either they weren't prepared for it, or B, I don't know, there's something they ain't telling us. Anyway, all right, look at this. Department of Justice probe involves claims that Tesla cars can drive themselves with autopilot active. Tesla faces U.S. criminal probe over autopilot technology. Oh my gosh, this is such a ridiculous, like, politically motivated garbage. I mean, criminal probes don't mean anything, but I wouldn't be surprised if the stock moves a little bit on that sort of news. Let's go to our usual Weeble, which, of course, with we could get 12 free stocks. We've got the Twitter overhang finally over for Tesla. Yeah, this is probably when that news dropped right here, when we had algorithmic selling, and you could see that was rebought right away. So nobody cares. Nobody cares about autopilot FUD. All right, we're still on Fox. Sorry. Here we go.
To inspire you to live in your now. Jordan, thank you. Good luck.
Good to be with you.
Major averages snap a three-day winning streak. The Dow, S&P, and NASDAQ are losers at this hour. Look at the Dow. Too close to call for the Dow. Meta after the bell. That'll do it for us. We'll see you tomorrow.
All right. Now, if we could just take a moment before we do earnings here, just to please appreciate the color coordinating we got going on here. Okay, straw matches Per Potion, jacket matches House Hack, level 99 fishing. You know, I mean, Next up, course on how to dress. Apparently, I'm a really good wearer of vests, by the way. Okay, let's go ahead and get into earnings. So, QuantumScape, Upwork, Spirit, TDOC, Ford, Snowflake, and Meta. I always feel like Meta's not exactly the fastest, but they are supposed to report in 4 minutes. Teledoc's supposed to report right now. They're supposed to be first on deck. ServiceNow comes out at Spirit Airlines isn't actually until 3:15, so we're not going to do Spirit in this one. Let's take Spirit off of the title. Done. You're fired. All right. Spirit will be later. We did have some talk about Boeing this morning seeing supply chain snarls for their aircrafts, which is really interesting because in their prior earnings calls, they actually didn't complain about supply chain issues. They were one of the bright spots that suggested, their supply chains were improving. So, oh well. Now what it was. So we have here, we have Alaska Airlines betting big on the 737 MAX. I've actually been on a 737 MAX before. It's kind of scary the first time I was on it, but I also figured, I'm like, hey, I guess now after so many people died, the kinks have hopefully been worked out. That's a pretty terrible way to look at it, but it was a little stress relieving. It's just so bad. Apparently, it was just a training issue, by the way, with the Boeing 737 MAX accidents that occurred, which is actually oddly comforting that there was an override for the failure that occurred. The failure, I think it was like a single sensor failure, and there was an opportunity to override by rotating some kind of crank or something, and it disables this automatic correction from the Boeing 737 MAX. And apparently training was just terrible for pilots for that potential occurrence. It was never highlighted until obviously the accidents occurred, which delayed the airworthiness of the 737 MAX for, a couple of years. I mean, there's some airlines who picked up the 737 MAXs and they just have them sitting on the tarmac. Yeah. All right. Come on, friends. Come on. If you haven't seen yet, Zillow is laying off about another 5%. Okay. Come on. Waiting for numbers. Boeing was down 8.8%, by the way, today. It's quite remarkable. Waiting for QuantumScape, Upwork. It actually looks like, we don't have a summary of it yet, but it looks like Upwork may be giving us a sheet. Let me see if I can get it here. Upwork Investor Relations. Obviously, still waiting for TDOC. They were supposed to be first. 405 is the big release. That's in a couple minutes. All right. Let's see here. Okay, yeah, we have Upwork out. Let's see if we can get their conference calls at 2 today. That's going to be an interesting one, actually, to read the earnings call on. I'll read it after the fact because of you're going to want to pay attention to the hiring. And Upwork is an interesting place for that. So, really? Quarterly results? Oh, it's not actually out yet. This is just it will be posted here. This is dumb. Waiting for earnings is always the fun part. Facebook, come on. Waiting for ServiceNow as well. All right. Waiting. No earnings yet. ServiceNow is implying a 6% move. All of them on standby for earnings. All right. It does actually look like Upwork is in. Okay, here's their letter. Is that for today? I don't know why Upwork has to make it so complicated. Oh, this is ending June. This is their Q2. No, it's not out yet. Yeah, no wonder I'm not getting a summary. All right. We'll have to wait on Upwork. They're making it challenging for us today. No problem. We'll just keep talking until stuff comes out. So, okay, Facebook, there it is. Q3 revenue, 27.71. Estimated active users, slight miss, 2.96 billion versus 2.97. Facebook daily active users actually, so the monthly active users slightly missed. Daily active users comes in at 1.98. The estimate was 1.86. So daily active users was actually up, but monthly was down. So more engagement by the people who were on there regularly. The forecast was a miss for Q4 due to a 7% headwind to year-over-year revenue growth expected in Q4, expecting now about 31.5, it looks like, $billion of revenue versus the 32.2 expected. That actually, yeah, 31.75, somewhere around there. Currency headwind 7%, EPS coming in 1.64. It's a miss on the EPS instead of 189. Top line revenue beats slightly, 27.71 versus 27.41. Making changes across the board to operate more efficiently, about in line with this quarter. In other words, no more hiring. Okay, TDOC, total visits, comes in with a miss of total visits. 4.57 million versus 4.8 million. Less people visiting the doctor through Teladoc, apparently. However, total access fees beat 540.1 million in access fees. Wow, versus 532.3 expected. You had adjusted EBITDA, big beat actually. Wow, 51.2 on the bottom line versus 39.9 expected. Fiscal year revenue guide on the low end of 2.405, with the expectation being 2.45. That's a big miss on the fiscal year revenue. Q3 revenue does beat by about $2 million, 611.4, beat by about 1.8. Fiscal year revenue, again, a miss, and so lower visits, but higher fees is what we see here. Ford reports EPS of 30 cents versus 31 expected. Slight miss. However, top line revenue 37.2 versus 36.9. That's actually a slight beat on the top line revenue, but miss on the bottom. So probably some higher costs involved here. Pre-tax impairment on Argo, their stake in Argo. So almost $1 billion loss on their stake in Argo. A loss of $827 million. The CEO says we will hire talented engineers from Argo. Interesting. Ford, Volkswagen-backed autonomous driving firm Argo to shut down. Oh, interesting. They're going to shut down Argo. They're going to bring over what engineers they can, and then they're writing off an $827 million loss. Fiscal year free cash flow actually coming in at a beat, expecting to be about $9.75 billion versus the expectation of $6 billion. I mean, that's great. That's 50% more free cash flow than expected. That's very, very good for Ford. We've got Ford Q3 EPS. This would be the non-adjusted EPS coming in at 30 cents, and that is a miss compared to the 32-cent expectation. Going back to Facebook for a moment. Okay. Sorry. This is actually a good thing. Growth rate of 2023 operating expenses to meaningfully decelerate. That means cutting jobs, joblessness, operating more efficiently. That means fire people you don't need and hire people you do need. Holding the same teams flat in headcount, shrinking others. There you go. Shrinking some of their departments. Facebook sees Reality Labs, that's their virtual reality segment, and they expect the operating losses for Reality Labs to be significantly higher next year. So really continuing to invest in this AI nonsense. Again, I think 20 years too early, but that's fine. Facebook down about 7% after present revenue misses the midpoint on forecast. Again, daily active users were up 3% year over year, slightly up on the daily, slightly down on the monthly active users sequentially, although still year over year, 2.96. Remember, sequentially means quarter to quarter versus year over year. Okie dokie. Ford Q3 revenue from China, $400 million. South America revenue, $900 million. Raising that free cash flow guide by 50%. Really, that should be great. I wonder how Ford stock is behaving on that, because that's red. Down about 1.56. That's crazy. I mean, I know they missed a little bit on EPS, but honestly, and they took that impairment, but that free cash flow number is great. Teladoc up 12% post-market on this beat. That's impressive. That's showing some staying power over at Teladoc. Teladoc, let's see how they've been doing. Let's see here. After hours now, Teladoc sitting up, 12%. Year to date, this stock is down 71.88%. Kind of bouncing off the floor right now. Upwork post-revenue or fourth quarter guide, slightly lower than expectations. Not getting a good breakdown here on Upwork, but I can tell you, yeah, after hours, it's looking flat. Upwork's another one that's down like 62% this year. QuantumScape not out yet. ServiceNow just out. ServiceNow coming in with adjusted revenue in Q3 of $1.93 billion. Adjusted EPS coming in at a beat, 1.96. The estimate was 1.85. Subscription revenue coming in at 1.83 to 1.84. The guide was 1.93. That's a slight miss on forecast. Revenue and forecast. Well, forecasted revenue misses. Fiscal year subscription revenue, also a miss by about, what is that, $100 million. Yeah, I mean, that's a miss. But then again, I have like it's it almost feels like a rounding error when you're talking about $6.8 billion, but whatever. And that's $6.8 billion of subscription revenue. And their Q3 revenue was about $1.83 billion. That's big. I mean, they are a big company, worth noting. Mm-hmm. Let me see here what's going on with QuantumScape. When are they coming out? 4:15 for QuantumScape. That's in about 3 minutes. You know, they don't make any money yet. They're still trying to do their fancy, what's it called? Battery. So their solid state battery. Alphabet closes down 9.1% after that disaster of, what's it called? Earnings yesterday. All right, what else? So Upwork sees fourth quarter revenue about slightly lower than expectations. 159.7 million was the expectation, coming in with a midpoint of 159. Fiscal year revenue 615 to 617. The midpoint there would be 616, and they were expecting to be somewhere around 4. Oh, so the fiscal year they're actually expecting it to be higher. They were expecting around 614, so slight move up there. Fiscal year adjusted EBITDA loss of 7 million, and the expectation was 11.7. Oh, that's good. Oh, that's good. So they're reducing some of their loss expectations here. So we're going in the right direction here. Revenue came in at 158.6 million versus the estimate of 157.3. So a slight beat there on Upwork, and it looks like they're actually getting a little bit more efficient within the company, which is great. China lost before interest and taxes, loss of about 193 million. For Q3 North America, EBITDA of 1.31 billion. That misses the 1.4 estimate. Q3 sales for Facebook down about 4%. Let's go ahead and get the Facebook investor relations. Let's see what we got. Facebook, Meta, investor relations. Facebook now down about 7%. We'll go ahead and look at their financials. While at the same time, next on deck, we do have QuantumScape. So I'm going to keep QuantumScape up while at the same time we're going to get through the press release here on Facebook. These are the kinds of analyses that we do. It's just sort of just a sample, and this is a little bit more earning style, but these are sort of samples of work that we do in our course member live streams, really trying to find fundamental patterns in companies that we're regularly analyzing. You can do whatever you want, obviously, with the data. It's kind of fun. All right, so here we go. Facebook reported results for the quarter ended September 30th. Our community continues to grow. Pleased with the strong engagement we're seeing, driven by progress on discovery and products like Reels. Problem is Reels, man. These don't make money. While we face near-term challenges on revenue, the fundamentals are there for stronger revenue growth. We're approaching 2023 with a focus on prioritization and efficiency. I mean, this is what we heard from Google yesterday as well. And anytime we have this focus on efficiency to navigate the current environment and emerge a stronger company, I mean, they're not wrong. I mean, that's what you do during a recession, right? The recession playbook is lay off, slush, and keep productivity. And you would rather work existing employees harder, and they get to stay, basically, right? And share in the benefit of upside of the company, whereas slush doesn't. Simple. Okay, what do we have here? So in revenue, look at that. Here's your earnings recession. This is what an earnings recession looks like. You have $27.7 million of revenue. That's down 4% from last year. Their costs and expenses, folks, increased 19% at Facebook. Wow. Then you've got income from operations. What is this? Well, it's like down 50%. Operating margin, effective tax rate, net income. Wow, look at that plummet on net income. So when you see net income and earnings per share and top line income plummet, to the tune of potentially 46%, I mean, the growth is gone, right? And that's the problem. This is why, and I know it's been very painful with the Tesla and with the Twitter overhang and stuff like that, and it hasn't been working out, at least temporarily. But one of the things that's so neat about, for example, Tesla is you are expecting top line and bottom line revenue growth, right? Just as a comparison, and that's rare in a recession that you're going to have that. Usually, you have this at newer companies. Typical at newer companies in a recession. So this isn't like unique to Tesla. Look at Enphase. It's the same thing. Numbers are still growing. The problem is for Enphase is if there's a substantial real estate slowdown. As long as people keep spending on their houses, though, you have no issue. Okay, we talked about the daily active users being up 3%, but the monthly active users also being up 2% year over year, but actually being or coming in slightly under expectations, declining a little bit there with expectations. Wow, look at this. I mean, this is why the labor market has been so tough for finding people. It's literally right here. Headcount was 87,300. This was back in, well, yeah, I mean, that's a 28% year over year increase. That's remarkable. Do you imagine hiring 28% more people? Crazy. Facebook's average price per ad, apparently. Oh, I want to see that. 18%. Average price per ad is down 18%. Where is that? Where is it? I just got that. I really want to see it, though. Oh, there it is. Average price per ad down 18% year over year. I mean, this is the same thing, the same issue that you're having at YouTube, right? So explains YouTube issues as well for Google. And what we have here, ad impressions and price per ad increased by 17% year over year, but the average price decreased by 18%. That's very interesting. So still you have more people using online to advertise. This makes sense and follows trend, right? But revenue down because of recession, presumably. Now, is that, let me see here. Apps. It's just interesting to me that we're seeing in a recession more ad impressions. Oh, impressions. Oh, it's not more people using online to search. It's more people using Facebook. Seeing ads. Okay, let's get rid of that. But money down because of recession. And I could say, yeah, okay, that makes sense. Get that fixed. So what else here? Yeah, regarding the course members, there is another live stream. We do that generally at like 6:45 every morning. It's kind of like a market open, but it's more focused on like fundamentals and earnings. Yeah, and mostly, I mean, fundamentals, whether it's real estate or stocks or both. So to provide some and Q&A, to provide some context on the approach we are taking towards setting our 2023 budget, we're making significant changes across the board to operate more efficiently. Again, this is just recessionary talk, right? Let's see. We've increased scrutiny on all areas of operating expenses. I mean, this right here, pure recessionary talk, no doubt. I mean, this is kind of what you saw at Google, right? Even Google talked about companies spending less and being more hesitant to spend. I write this down just as like little opportunities for us to kind of signpost what we've got going on. I find if you just run through and try to highlight a bunch of stuff, it doesn't work well. QuantumScape, by the way, EBITDA loss comes in at 67.4. The estimate was 67.7. So pretty much in line there. CapEx, the low end of 175 to 225. And okay, I mean, maybe slightly better. Okay. They still have so much R&D to do, though. Some steps, like the ongoing realization of our office footprint, will lead to incremental costs in the near term, but this should set us up well for future years. And this is really the theme, is like it's recessions like this that you want to find companies that that you really want to invest in, right? We expect 2022 total operating expenses to be in the range of 85 to 87 bill. Let's see here. All right, $2 billion in charges were related to consolidating our office footprint. Ooh, juicy. All right. What else? Infrastructure Reality Labs hardware costs driven by the launch of our next generation of our Consumer Quest headset later next year. Okay. Reality Labs expenses are included in our total expense. Okay, so they're going to come out with a new headset next year. Because PlayStation just came out with a new headset as well. I'm not the biggest fan of this, but okay. We do anticipate Reality Labs operating losses will grow significantly year over year. Yeah, that's not great. So really, they're burning. Like, you've got two companies here at Facebook. You've got one company that makes a lot of money, and that's with ads. But then they burn that money on virtual reality. Sucks. Webcast and then the about. Okay, let's see. Looking at some of their state, I mean, they've got plenty of money though. It's just your EPS is going to get burned, right? So do some quick math here. R&D. Wow, look at their R&D. That's like a 50% increase. One sec. Okay, calc. There we go. Okay, so R&D up 9170 divided by 6316, 45.19%. That's for R&D. Marketing and sales, that's almost flat. Wow. 3780 divided. That's actually unique if you look at if you compare that to Google. I'm about to. Wow, their marketing, that's R&D. So they're spending money like crazy on R&D, whereas sales was up 6.3%. You compare that to Google. Hold on a sec. Where was Google? Google. Here it is. This was Google yesterday. Look at that. The R&D for Google was up 33.5%. So you go back over here, their marketing was only 6.3% versus 33% at Google. That's fascinating. There we go. G&A looks like about 10% up. Okay, so nothing super unique here. If we look at assets, we got a lot of money. I mean, we got plenty. 14.3 billion in cash, 27.468 in marketables. Accounts receivable, you could probably count that as well as I mean, it is a current asset. Prepaid expenses, I generally don't count that. But if I took the 11, it puts me at 41 to 53-ish. And we look at their current liabilities, they have about half that. So they have roughly twice as much cash as current liabilities. They have a long-term, a lease doesn't really count, long-term and other liabilities, another 17. They're really no. I mean, I don't really see capitalization risks here. This is fine. They could pay off all their debt tomorrow if they wanted to and still have money to function. So that's not a problem. If we look at their cash flow statement, their free cash flow is like zero. What are they spending all? Holy smokes. Look, this is what they're talking about with this purchase of property and equipment. Look at that. That's a double of purchase of property and equipment because they have operating cash flow of 9.6 billion, but they spent almost all of their operating cash on these buildings or these offices. That's what they're talking about here. Capital expenditures to be in the range of 34 to 39 billion, driven by our investments in data centers, servers, and network infrastructure. See, and that's where you have to wonder, like, do you want to invest? And I would ask yourself this, okay? Because if you want to know, like, why is Facebook down? Okay, let me give you an easy one here, okay? You got to ask yourself, do you want to give Facebook money so they can go spend 34 to 39 billion dollars on server infrastructure when you could give that money to Amazon, who's actually building like a pretty powerful, AWS cloud platform? I'm not saying Facebook doesn't have cloud. I mean, obviously they do, but it's just like, any revenue they get from that, not only are they now blowing it on actually establishing the servers, but they're going all in on the metaverse. That's where the money's going. I wonder how much that is growing. Let's see if we could look at expenses. It's just so early with the metaverse, and it's just not there yet. Again, maybe they'll be the ones to have the breakthrough, but you're taking the leap of faith that they can pull it off. Maybe they can. R&D's up 45%. What was the R&D up for research on Google? Google was only up. Oh, I screwed it up. Sorry, I flip-flopped this. Good thing I looked. Google's sales and marketing was up 25.6%. Their research and development was up 33%. My bad. Let's fix that really quick. Verse 20 versus 23%. Was that what it was? Something like that. 25.6%. Get it right, Kevin. 25.6%. There we go. Okay, good. So that's Facebook, man. You've got a company just burning money on the virtual reality. And it's not to say it's a bad company. I don't want to come across as like bearish or like negative or whatever. It's just that it has never been my favorite. And it's because I think if you're an investor in Facebook, you have to believe in their metaverse vision. If you think Facebook is going to take metaverse to the next level and they're going to be the ones to pull this off, absolutely, by all means, Facebook seems like it makes sense. What do we have over here? Segment info. Thank goodness. So, I want costs. Revenue, I know, is basically just Facebook. Income loss from operations. Wow. Look at Reality Labs. Well, here, you could figure out their cost. Just add their income to their loss over here. They burned about $4 billion. What? Dude, how do you burn $4 billion in 1 month? Or sorry, in 3 months on Reality Labs? I want to know, how do you burn $4 billion on Reality Labs in 3 months? That's a 1.33 billion burn rate for virtual reality. I mean, in fairness, I mean, their operating right now is generating them about 9.6 bill. Well, no, but that's the cash flow statement. Net income's 4. Net income's 4.4. Okay. So if we look at here, let's go. Where did I write that? Oh, here it is. So, there. So really 4.4, 1.33 divided by 4.4, 30%. 30% of Facebook's net is going to virtual reality. If you want to invest in Facebook, IMO, you absolutely have to believe in the metaverse, the metroverse. Yeah, that's probably basically what it is right now. Well, that's my take. Yeah, something like that. Yeah, that's not good. All right, fine. Fine then. All right. All right. Well, that's Facebook. So Facebook's a disaster. Now, we looked at, let's see here. It would be interesting to see if there's any commentary from Upwork on jobs. Like, are people making more money? Are people making less money? Facebook's the new Yahoo. Oh, man, that's a diss. Oh, there we go. Finally, their letter's up. I knew I wasn't going crazy. I kept getting their Q2 crap. It just wasn't there yet. All right. Wow. That looks very uncomfortable. All right. Dear shareholders, don't care. I want this. I get excited when I see these white and blue statements. That's it. Like, that's the stuff that gets me going. Show me a statement of cash flows, man, or an income statement. It's so juicy. All right. Wow. That's actually really good marketplace revenue growth. 145 divided by 117. 23.9%. Oh, wow. I mean, that's not bad year over year. I don't know what managed services are. I have no idea what that is. So I'll put a little note there that I have no idea what that is. Whoa, their cost of revenue didn't move much. Not that much. At least I don't think so. Hold on. Maybe they did move in line. Let's see. 34933. Oh, yeah, it's better. 15.8%. That's good. So they have more growth. Like, they're growing more than their actual costs are going up. That does not seem to be the case, though, here on OPEX. Oh, man, you guys ruined it. Why? 41%. Ruined it. All right. Why? Was that mostly marketing that went up? 63 divided by 43. Yeah, 46% increase. Again, probably staff, just becoming more expensive. That's a bummer. Look at that. You were moving towards profitability, and then nope, you had to lose more money. Dang it, Upwork. Speaking of money, how much money you guys actually have to be able to lose? That's about 650. Funds in transit. Yeah, I don't know what any of that crap is, so I'm going to go with 650. Like, if you could pass Kevin's cash flow test, that's good. Escrow funds payable, held in out. Okay, so I'll wash those out from assets and liabilities anyway. Accounts payable, accrued expenses, deferred revenue. Deferred revenue, I'm not going to count. Accrued expenses and payables, 55 million. They've got like no current liabilities. I mean, they've got, 13x cash versus current liabilities. I mean, it's really, really good. So that's fine. The long-term debt, non-current, is a lot, but it roughly matches their cash. I mean, it's 100 mil. There's 100 mil left over. 5633 mil long-term debt. So cash could wipe all debt, basically. Okay, that's fair. So cash flow, let's see here. Operating cash flow, transaction losses, net loss, 24, stock-based comp, operating, investing, property and equipment was nominal. That's fine. So we had net cash provided here of about 10, what are we in? Thousands? $10 million in cash. Woo! And then they had some changes in escrows. So net cash, changing cash. Okay. So, I mean, they're not burning so much money to where they're like a bankruptcy risk. They've got plenty of liquidity. Like, I don't see a bankruptcy risk on these statements, in my opinion, which is good. And their revenue growth is actually pretty decent. It's just their operating expenses are popping off a little bit. So let's see if they say anything about the market. The deceleration quarter over quarter, reflect, look at this. Wait, what percentage is that? Which is a 16% year over year. Oh, look at that. So they're actually going from 23% to 16%, down to 16%. That's interesting. And they say that's because of continued softness in seasonal and macro conditions. and the lapping of strong fourth quarter. Okay, yeah. All this lapping talk. I mean, that's all Google talked about too, was lap, 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 lap. It's like, all right, gotcha. All right. So reiterate our target to be adjusted EBITDA positive. Wow, look at this. They want to go, well, adjusted EBITDA. Adjusted EBITDA could be a total scam. But anyway, starting in 2023, well, that'd be cool if you guys went cash flow positive. We'll see what it actually is. Huh. Upwork is not bad. You know, they're going to get reamed as a profitless company in this sort of environment, which they have been. But otherwise, it's actually not a terrible company. Oh, what's this? Active clients. Whoa. What is this? Year-over-year growth. Oh, wow. Look at that. Okay, I get it. So this is the growth rate of their active clients, and the growth rate of the people using Upwork is plummeting. So that's a red flag of active clients plummeting. I mean, I stopped using them. I was using them during the pandemic. So you still have some pandemic overhang here on decelerating growth. Yeah. All right, cool. All right. So that's Facebook. We could briefly look at ServiceNow. ServiceNow. Investor relations. So they, by the way, do a bunch of stuff. A lot of it is like app workflows and creating your own, apps, whether that's for service or operations, security, compliance. I mean, they have a ton of crap. So software, right? All right, ServiceNow, investor relations. All right, what do we got? Let's see here. Hold on a sec. There we go. Oh, these are pretty. All right, so GAAP to non-GAAP reconciliation. Just give me the numbers, would you? I wish they would just give me the statement. Here we go. This is what I want to see. So look at this. Subscription revenues up 22% at ServiceNow. That's actually really good growth. That's great. And what else here? Performance obligations, cash flow, subscription revenues on guidance, expecting an increase. Still, that's actually still strong, still in that 20% region. ServiceNow is up like 10% in after hours, by the way. So they're still growing their subscription revenue quite decently. Any commentary on the macro? Because it doesn't look like if they're not decelerating in the rate, in the year-over-year rate, then that's actually a good sign for them. Renewal rates, yeah, they seem to have low churn once you're in there. North America is the biggest customer. Headcount by department, we're at 20,000. Year over year, that headcount growth is actually pretty decent too. When you go 20,072 divided by 15,947, a 26% roughly increase in headcount. Margins, fine. And they want to give us a reconciliation here. Okay. So ServiceNow actually is doing quite well. R&D, this is just a breakdown of stock-based comp. This is how they're going to reconcile. Okay, that's fine. These are, I prefer the SEC statements so much, which those might unfortunately not be out yet. Let me see if they are. They might not be, though. Q3, no. Oh. Ooh, this might be it. Financial tables. Got it. This is what I was looking for. Much, much, much better. Okay, So, any notes here on the economy? Beat on both bottom and top line goals. Let's see. 22% growth in customers. That's what you want, unlike what you're seeing at Upwork where you're decelerating. They're stable. During the quarter, help design. Okay, these are more apps and such. Here's their outlook. Currency headwinds, subscription revenues. Yeah, I mean, maintaining that growth over 20%. Give us a lot of info, though. Where are the actual tables? There we go. Here's their cash flow statement. Here's their balance sheet. There we go. This is what I'm used to. Okay, so most of their money is obviously from subscriptions here. 1742 divided by 1427. That's that. There's exactly that 22% growth. And we can actually see if that's decelerating at all by looking at here. Divided by 4050. Yeah, it is a little bit. See, this was 24% growth over here. And now we're at 22% growth. So a little bit of a deceleration, but actually holding up. Their cost of revenue, man, look at that. This is the kind of business you want to be in, where your cost, like you make $1.7 billion, but your cost is 301. That's the kind of business you want to be in. Sales and marketing doesn't look like it increased that terribly much. 579. No, sales and marketing only went up by about 20%, which you would expect, given that their revenues went up just over 20%. R&D, G&A. This looks normal and good. What's their valuation, though? See, they're making 39 cents right now, which would be about $1.56 on an annual basis. But if I go, let's see, ServiceNow. Let's see what their forecast is. Wall Street's expecting how? 729 of annual EPS. They just did 30 cents. Well, that doesn't make much sense. I'm looking at the right statements. That seems remarkable to me. How are you going to get to? Oh, it still says $7.29. I don't know. That doesn't make much sense to me. I'll have to see why that estimate is so off. But anyway, at 39 cents, if I just annualize that, that's $1.56, and then divided by their price. What aren't they like $390 or something like that? Now stock. We are at 172. 172 divided by $1.60. That's 107 PE ratio. If they were actually to make $7, that would be a little bit better. 172 divided by $7. See, that'd be 24. So not too sure about those EPS projections, but I would try to get to the bottom of that if I were super into ServiceNow. Every client I deal with is in IT and is a ServiceNow customer. Their market reach is incredible. Fascinating. Thank you for sharing that. Best investment, RuneScape party hat. No doubt. All right, there you have it. Thanks so much for being here. Check out the courses on building your wealth link down below. Use that Halloween coupon, and we'll see you soon. Thanks. Bye.